Okay, so how do LIBOR and SOFR rates influence gold prices? So first of all, what is LIBOR? So LIBOR is the London Interbank Offered Rate. That's what it stands for. And it is an interest rate average calculated from estimates submitted by the leading banks in London. Each day, 18 international banks submit their ideas of the rates they think they would pay if they had to borrow money from another bank on the interbank lending market in London. To help guard against extreme highs or lows that might skew the calculation, the Intercontinental Exchange Benchmark Administration strips out the 4 highest and the 4 lowest submissions before calculating an average. Now, the resulting average rate is usually abbreviated to LIBOR. But LIBOR is prone to extreme manipulation. This is because LIBOR isn't set on what banks actually pay to borrow funds from each other. Instead, it's based on their submissions related to what they think they would pay. As a result, it's possible for the banks to submit lower and lower rates and manipulate the LIBOR fairly easily. So, when LIBOR is too high, it becomes too costly for banks to borrow from each other. And it also makes all loans more expensive. This reduces consumer demand and that slows economic growth. As a result, gold price increases. When LIBOR is too low, it becomes very cheap for banks to borrow from each other, makes all loans cheaper, increases consumer demand, accelerates economic growth, and so the gold price falls. But scandals exposing manipulation of LIBOR has led many national regulators to identify alternatives to LIBOR, and that alternative is called SOFR. So SOFR is a secured overnight financing rate, and it's calculated differently from LIBOR because it uses actual costs of transactions, not estimates by panel. In the overnight repo market, calculated by the New York Federal Reserve to generate the SOFR figure. SOFR is considered a less risky rate because US government bonds serve as a collateral in the borrowing. Due to this less risky nature of SOFR, this helps keep borrowing costs low or lower for companies. Now, unlike the forward-looking LIBOR, which can be calculated for 3, 6 or 12 months into the future, SOFR is calculated based on past transactions, which limits the rate's predictive value on future interest rates. In addition, SOFR is overnight, whereas LIBOR can have longer tenures. Essentially, SOFR is a broad measure of the cost of borrowing cash overnight collateralized by treasury securities. So if SOFR rises, cost of borrowing becomes too high, and this has negative implications for the economy, of course. Less economic activity, less investment, less borrowing for businesses, for mortgages, etc., etc. So, as a result, the gold price rises. Now, if SOFR falls, the cost of borrowing becomes too low, and this, of course, has positive implications for the economy, and as a result, the gold price falls. Now, there are some other alternatives to both of these rates. So one of the alternatives are One of the alternatives is Sterling Overnight Index Average, SONIA. So in the UK is administered by the Bank of England. It reflects the average rate for overnight UK pound denominated loans among banks and financial institutions. Federal funds of overnight index. So this rate is what US banks pay each other for unsecured loans from their reserves held at the Federal Reserve. A LIBOR is an index so based on unsecured borrowing costs of small and medium-sized banks across the US. The information is stored via blockchain, and an index is created using a credit-weighted average of the unsecured loans involved. And then there is the US prime rate, and the prime rate has been used for years as a benchmark for setting credit cards, home equity line of credit, and other APRs. So the prime rate is based in part on the federal funds rate. And all of these alternatives, rates, indicators, they all have the same positive relationship with the gold price. So when, for example, SONIA increases, the gold price also increases. When the federal funds overnight index increases, gold price increases, and so on and so on. So they all have a positive relationship with gold prices.